right, here we are. Another episode of the Know Your Numbers REI podcast. My name is Chris McCormack. It's an honor to be with you. I greatly appreciate and value the fact that you guys are taking time out of your day to listen to this podcast. And I believe it is of great value, especially as we continue to discuss the one big beautiful bill that is now law in the United States. You can go back to previous episodes and hear a little bit about what we've been focusing on and where our efforts are in terms of unpacking this thing. Again, it's a massive piece of legislation. It is no simple task going through it. And so I understand that you guys, as business owners, real estate investors, high income earners, people with families, everything and in between, you don't have the time or the desire to go through these things. So the fact that you are here listening and unpacking it with us is appreciated greatly over here. And I believe that you will receive a reward in the fact that you will understand more of what's going on in our tax environment and how you can best implement strategies to pay less in tax, grow wealth, and continue to provide for you and your family now and into the future. Today's episode is going to be focused on one of the bigger changes in the tax law as a result of this being passed. Again, this was passed July 4th, 2025. We're recording July 7th, 2025. It's probably going to be released mid-July. None of that really matters except for the fact that it was passed on July 4th. And that it is now law. This is stuff that you can rely upon as you can rely upon any other law. Previously, when we did our first 4 episodes, it was still making its way through Congress. There was a lot of resistance, or I guess more resistance than some might have expected because of the debt ceiling. I go into some detail about that. But now it is officially law, and we can unpack it and start to make decisions that will benefit you and your wealth, your business, your investments, while also abiding by what is legal and ethical. So if that sounds like something you're excited to get into, then let's do it. If you get any sort of value out of this, please do us a favor, leave us a review. You can subscribe to our podcast on Spotify. We're on YouTube, so if you're just listening, go ahead and subscribe on YouTube and you can watch us. And then if you know of somebody who this might pertain to, or they might be thinking about some of these things and how they can make use of it, then please do us a favor and do them a favor by sharing it with them. We want more people paying less in tax so that they can grow their wealth, and we want them to do it legally and ethically and know that it's something that they can take advantage of, but doing it the right way is of the highest importance. So let's get into it. We are going to be unpacking sections 70301 and 70302 of this one big beautiful bill. This thing, again, is massive. Let's see if I have the full. It's 870 pages. It's not all tax related, but taxes make up a large percentage of it. There's some details around Medicaid and Medicare and other governmental programs, health, education, labor, and pensions. So you can spend months trying to read every last bit of this. We are going to be focusing on the tax stuff. Obviously, that's what we care the most about. And so if you are wondering what the rest of the bill says, what the rest of the law says, well, this is not the place to be. But if you're wondering what it says as it relates to taxes, this is the place to be. These are part of subchapter A, permanent U.S. business tax reform and boosting domestic investment. So, and that's in chapter 3 of this 870 page document. So all throughout this law, they have chapters and subchapters and then sections. And the chapter sets the theme of the subchapters, and then the subchapters kind of take it a little bit deeper. This one is U.S. business tax reform and boosting domestic investment. So it gives a purpose behind the next. This has 9 sections, which is kind of cool how they did it. Like you can understand, and that's what we want to do, is understand why it's happening and how we can make use of it. And so these 2 sections are about full expensing related to investment in your business property, and then investment in research and experimental expenditures or research and development expenditures. That one is the bigger one because this is brand new, and the business property has been in effect in the past and is now being permanent and increasing. So we're going to unpack both of them. Let's do it. Let's start with 70301, which talks about the full expensing of investments in business property. So this section reinstates and makes permanent the 100% bonus depreciation for business property. This is amazing for our real estate investors. We have been talking about this for years on years because as of 2022 was the last year that we had 100% bonus depreciation. And even before then, it was only between 2017 and 2022. I might have my dates off by 1 year, but that 60, 80. So yeah, 2023 was the last year for 100% bonus depreciation. 2025, it was going to be 40% bonus depreciation. That is a fraction of what was 100% bonus depreciation in the 2022 time period. And so when we think about strategic tax planning, and especially as it relates to real estate investors or business owners who invest a large amount of dollars into business property, say you're a doctor or a dentist and you buy these large pieces of equipment or a large amount of furniture that has a high dollar amount to it. From 2017 to 2022, we were able to strategically plan about how we were going to invest in those pieces of equipment and tangible property, and then we would be able to receive a 100% expenditure using a part of the tax code. But what happened in 2023 was that it started to phase out. So 2023 was the first year that it wasn't 100% bonus depreciation. It dropped down to 80%. So when we advised clients in 2022, we were confident that we could get 100% bonus depreciation. So certain property that qualified, usually in the 5-year range, we could itemize out and get a full deduction for the value of that property. So you've heard me talk about, and maybe you haven't, but if you've been with us for a bit, you've heard me talk about cost segregation. And so one of the benefits to cost segregation is that it segregates out all of the costs associated with your property, your real estate investment. And so when you do that, you break it out into 5-year, 7-year, 15-year, 27.5-year, and maybe even 39-year if you have a specific property. That gives us the ability to accelerate some of this depreciation, because rather than having the 5-year being depreciated over 27.5 years, you are now dividing it over 5 years and getting more upfront than you would if you just took the whole investment over the course of 27.5 years. In addition to that, up until 2022, the end of 2022, we could, for a qualifying property, get 100% bonus depreciation. So you're already getting accelerated depreciation just by cost segregating it. You can accelerate it a step further and get 100% of the value of that 5-year property as a deduction in year 1. So we have people that have $2 million buildings, commercial buildings or multifamily buildings, that you get $500,000 in, say, 5-year property, and now you get an expense, 1-year expense for $500,000. If you're a real estate professional making $500,000 in income as a real estate agent, or maybe you're the spouse of somebody who earns a high income and you make $500,000, that deduction completely erases that income that you had. So what was $500,000 in the highest tax bracket comes down to $0 through the use of bonus depreciation. That was phasing out. As of 2025, up until July 4th, we were under the impression that it was 40% for 2025 and 20% for 2026, and then it goes away. We don't get that 100% bonus depreciation. At the $500,000 level, we were getting 40% of that, so that is $200,000 compared to $500,000. So again, taking that scenario, 500 minus 500 is 0. 500 minus 200 is 300. You're still getting taxed on $300,000, which is not a small amount and is not in the lower tax brackets. So the difference is 500 versus 200, $300,000 that you are now paying taxes on as this gets phased out. The law is now complete. We have 100% bonus depreciation getting backdated to January 2025. So any investments that were made in 2025, even up until this became a law on July 4th, you now qualify for bonus depreciation. You can expense 100% of the qualified properties, which in that example is $500,000. So you just saved an additional, say, $300,000 at even like a 20% tax bracket would be $60,000. And that's a low tax bracket. If you're in the $500,000, you're at the 37% tax bracket, which is just about $120,000 because it's almost double the 20%. So this is amazing. This is an important detail. So what do you do when you claim bonus depreciation? You get a massive expense, but then in future years, you don't have that lying around. So what do we advise clients on doing? We advise them to then take the savings and reinvest it in another property year after year. And it makes all the more sense now that this has become law and is good, I believe, through 2030. The 100% expensing is permanent. I'm sorry. So these are, remember, I was talking about two different sections. One section is only through 2030. This bonus depreciation is permanent 100% expensing. So there is no going back. We don't have any more phase outs. We don't have any more uncertainty. We have a complete, confident playbook to take advantage of. So who is this for? This is for real estate investors. This is for business owners buying property. This is for doctors and dentists who have a large amount of expensive equipment. This is for construction workers who buy large amounts of qualified property. You can take serious advantage of this, and it is a great opportunity. If you have not heard about this, that means you've been missing out from 2017 to 2022 and even into 2024 because it was still advantageous. Like 200,000 is greater than zero, so we're going to take that if we can and if it makes sense. So if you have not heard of this, if your accountant is not advising you on this, now is the time to change, because now the opportunity is ripe for the picking. We have an opportunity that we haven't had in the past, in the fact that we can continue to rely on 100% bonus depreciation. So when we invest in a property, take bonus depreciation, get that immediate expense up front. We know that next year when we want to buy a property, we have the ability to do it and continue to compound these tax savings, continue to reinvest and grow our wealth. I'm excited about it. I know our clients are going to be excited about it because it is now permanent and it applies to them specifically. So that's section 70301. The other part of this, section 70302 of this big, beautiful bill, which is now law, is the immediate expensing of domestic research and development cost. Why is this important? Because if you were a startup prior to this being the law and you were investing heavily in research and development, you would have to amortize your investments into your company over the course of 15 years. That is not good, because when you're making a small amount of money and shelling out a large amount of money for investments, then you are hoping that you don't have a tax bill because all of your money is going to reinvestment in the business. However, if you are only getting 1/15 of that amount that you're investing in the business as an expense, there's a good chance that you're going to be paying taxes on the dollars that you're earning, even though you are currently in the red, losing money, because you're shelling it all out and reinvesting in the business. This law is allowing us to take 100% of the research and development costs and expense them right away. So startups will not be paying taxes if they're expensing more than they're making during those early years when they're putting money away to the reinvestment of their business, right? So think about it. All of the dollars that are going to pay employees who are doing research and development, all of the dollars that are going to invest into certain equipment or studies that are being done, market research, all of that up until July 4th was only 1/15 deductible, 6.67% of the amount that you were expensing as research and development was deductible in year one. Now it's 100%, just about a 94% increase in the amount that you're able to take as a tax deduction. And it makes sense that you should be able to take it because you're spending the money. So what does this do? This incentivizes us as those who are going out and starting businesses and creating startups and putting a lot of money into the vision of the company. It incentivizes us to do it more. If I was only getting 6% of the startup, well, I'm going to have to delay some of the research because I'm going to have to put money aside for taxes. Now, if I know that I'm going to be showing a loss in the first few years of my business, and I know that it's going to pay off because I'm investing in something that is going to produce a large amount of value in the future, I get 100% of the deduction. I'm going to continue to do that so long as it's making sense from a return on investment perspective, right? So this law is going to incentivize us as business owners and entrepreneurs and creators to continue to invest in new projects, which are eventually going to result in jobs for other people, value produced to the market, efficiencies. A lot of these companies are technology companies that are going to be creating something that is going to be a more efficient version of something that we're currently using. So it's not only providing a benefit to the business owner and the entrepreneur and those who are putting money into a business, but it's benefiting the economy because we're now investing at a quicker rate than we would be if we had to wait around until the next year to get another 6% of the dollars that we had already previously invested. So again, both of these together are quite the opportunity for those of us that are investors, whether it's investing in properties, investing in businesses. The research and development is profound because it is brand new. This is something that we've been struggling with for a lot of our startup clients because you can only expense the 6% a year. And it's like, okay, if I'm putting $100,000 into an investment into my business and I can only get $6,000 of that as a write-off, and I have a W-2, or we're making $15,000, which is only a fraction of the $100,000 that putting into the investment of this business, then that's a problem, right? If I have a tax bill, if I'm only getting $6,000 worth of write-offs, $15,000 worth of income, but I'm expensing $100,000, chances are you don't have a lot of money set aside for taxes if you're reinvesting into the business and showing a loss. So this is big. I think when it comes to actually planning around this and how we can make use of it, well, one is just that scenario. No longer, and maybe you weren't even doing this, you weren't aware of it, but you realized something was amiss, or you were paying more in taxes, or now you have like a tax debt to the IRS because you've already spent all your money in the investment of your business. Like, these are real scenarios that really happen. That's going away. Now that you get 100% of your research and development costs as a write-off in the year that you expense them, then you don't have to worry about showing a profit even though you're showing a loss. This can be kind of the issue when you're amortizing or depreciating things, is that you might pay 100% of it, but only get 6% of the deduction. And so this has been a topic of conversation. It's been an issue in the industry. It's hard having these conversations with clients who put $100,000 into the investment of their business and they can only get $6,000 worth of a write-off. Like, that's not a fun conversation to have. And so this gives us more of an opportunity to plan by saying, can I afford this $100,000 investment from a tax perspective? Yes, because you get all of it written off, and now go and grow your business at a faster pace and see that multiply at a quicker rate than if you have to keep money in a cash account because you might have to pay taxes even though you're making a small amount of money in comparison to the amount that you're paying out. So that's one way to plan when it comes to the 100% expensing of business property. In both of these, you want to make sure that you're with a CPA, a tax planner who you trust, who is actively working with you and around the year so that you guys are coming up with new strategies and developing ideas and creative ways to grow your business while keeping more money in your account and decreasing that tax burden that has hurt so many people in the past. So make sure you're working with a strategic tax planner. The other part is like, okay, consider your investments. If I know that I'm getting 100% bonus depreciation through the use of cost segregation on my real estate investments, well, now I can go out and buy a larger property because I'm not going to have to pay as much in taxes. Or now I can go and buy more properties because I don't have to worry about that large tax bill that I had in years past when we were only receiving 60% of the bonus depreciation. Understand that there is a cap on the amount that you can claim as bonus depreciation. It's $2.5 million on all qualified properties. So if you are buying multiple commercial buildings, you're going to want to make sure that you're still below that threshold, or if you're going above it, understand that you won't be able to get cost segregation for, or you won't be able to get bonus depreciation for anything that's above that threshold. And then the other part of that is, though, if you don't get it in this year, then you can still use it in future years. You get the deduction according to the year of investment. So this has helped a lot of our clients who were unaware of cost segregation until 2025, but they bought a property in 2022. They were eligible for bonus depreciation then, but didn't know about it. We can backdate it and do it's called a change in accounting method to help them take full advantage of that. So if you invest in multiple properties and you find yourself being phased out, so long as you don't go and get the cost segregation study done for this year, I would advise against that. Again, monitoring these thresholds to make sure that you're not above the limit then gives us the ability to go back in, say, 2026 or 2027 maybe you invest in multiple properties here in 2025, and then you don't invest in properties in 2026 and 2027, but you want to save on tax because you're still making a large amount of money. You can still do a bonus depreciation and a strategic carve out through cost segregation and other strategies on the properties that you bought in 2025 to lower the income in 2026 and 2027. So planning these investments, planning the research and development strategically, and working with somebody who knows that this is now law, because again, there might be people that haven't gone through the details of this law, and so they could be under the assumption, oh, research and development has to be amortized. And if I go, even if this is law, and I go in and say that $100,000 of research and development is amortized over 15 years, that's an error that happens just from the plugging in of numbers, right? If a tax preparer is not aware of this becoming law and they're pressed for time around tax season and they just want all of your details, they see that you invested $100,000 in research and development, they're so used to the way things have been that they put that on the amortization schedule and divide it over 15 years. Like, you are losing money by working with somebody who isn't aware of the ins and outs of this tax law. So somebody who's up to date and working with you throughout the calendar is the best thing that you can do in this time. If you are just now hearing about bonus depreciation, that is a sign that you need to get a new accountant, because this is something that has been available 2017 through 2022 and even into 2024. It's available, not at the level that we're about to enter into. But again, if your accountant or CPA or tax planner or tax preparer is not talking about these things, let's do yourself a favor, get on our calendar, talk to somebody who's going to proactively plan, build a relationship with you, confidently help you make decisions so that you can keep more money in your accounts and grow your portfolio, your business, your wealth, whatever it is that you want to do. Bonus depreciation, 100% is back and here to stay. Research and development costs can be expensed for 100% of the amount up through 2030. Now is the time to grow. Again, this is the Know Your Numbers podcast. My name is Chris McCormack, founder of Better Books. I trust this was valuable to you. Until next time, God bless you and keep moving forward.